Hey guys, hope you're having a great day. Your old buddy Tim back in the Revolved Realty studio. Today we are talking about something that has been coming up more and more lately in our current real estate market here in North Alabama, and that is the 1031 exchange. Now, the 1031 exchange is called a 1031 exchange because it's named after Section 1031 of the IRS tax code, and it is all about how real estate investors can sell one property, take the profits from that property, buy another property, and forego, postpone, maybe avoid some capital gains taxes. Now, let me say right off the bat here, I am not a tax expert. I am not an accountant. I'm not a lawyer. I'm just a realtor with a video camera, which can make me a very dangerous thing. So whatever I'm about to tell you, I want you to just take it for educational purposes. Talk to a real professional, a tax accountant or someone like that who can give you more information. I'm just going to hit the high points of the 1031 tax exchange. I'm not giving you tax, accounting, or legal advice. Okay? Understood? All right. Seriously, I'm just going to hit the high points of this because I do get a lot of questions about it. You should go to your accountant or an attorney and get full details to find out if this is something that would work for you, because in the right situation with the right numbers and the right properties, it's a great way for a real estate investor to avoid or postpone paying capital gains taxes. So I've got my notes here. Let me refer to them throughout this. The term 1031 exchange is defined under Section 1031 of the IRS code. To put it simply, this strategy just allows an investor, as I said, to take the profits from one property, invest in another, and avoid or postpone paying capital gains taxes. Now, if you were to have a home that you did sell and you made a large profit on, if it was your personal residence, you're pretty much going to pay capital gains on that. One of the rules of the 1031 exchange is it only pertains to business or rental property. Okay. So when should you do a 1031 exchange? Well, if you are an investor, let's say you've bought a piece of rental property, you've owned it for a number of years, it actually is appreciated in value. When you go to sell that property, you need to look at what is the profit you are going to make. For example, let's say you paid $100,000 for a little rental house a few years ago. You go to sell it today. It's suddenly worth $150,000. So you're going to show roughly $50K in profit. Now, what you can do is you can take that $150,000, find a like property, and invest your money into that property. Now, what do I mean by a like property? You have to go from one business or rental property, investment property to another. You can't go from a personal residence and roll that into an investment property. You can't go from an investment property and roll that into a personal residence. It has to be what's called a like exchange, meaning it has to be investment property. Now, it doesn't have to be exactly the same. I see people who will cash out of numerous single-family homes, ball that up into one big thing of money, and put it into an apartment complex. So as long as it's like, meaning rental or investment property, you should be good to go. And it is going to help you, again, avoid paying those capital gains taxes. Just remember, it all has to do with like exchanges, like property. There are a number of different types of 1031 exchanges. I'm not going to go into those in depth. I just want to talk about really the 7 rules that pertain to doing this, okay? I've already talked about number 1, like-kind property. To qualify as a 1031 exchange, the property being sold and the property being acquired must be like-kind, meaning they must be investment property. Even if they differ in size, grade, or quality, it doesn't matter. For example, you could exchange an apartment building for a duplex or a duplex for an apartment building. You can exchange a single family rental home for a commercial office. As long as it is investment property, you should be able to exchange and invest that money from one to the other. So again, talk to your accountant or your tax lawyer. That's rule number 1. Has to be like-kind property. Rule number 2, investment or business property only. I've already talked about this. A 1031 exchange is only applicable for investment or business property, not personal property, meaning that you can't swap your primary residence for another primary residence. I wish you could. Doesn't work that way, though. It has to be business or personal property. Rule number 3, it has to be greater or equal value. In order to completely avoid paying any taxes upon the sale of your property, the IRS requires that the net market value and equity, this is important, and equity purchased must be the same as or greater than the property sold. Okay, so let's take an example here. Let's say that you have a property worth $1 million. Good for you. And you've got a mortgage on that property of $500,000, meaning that you've got $500,000 in equity. So when you sell that property, receive the full benefit, the new property that you purchase must be worth at least the $1 million that the old property was worth, and you must have at least the same amount of mortgage on it. All right. Does that make sense? You can go greater if you need to, but you cannot go less. You can't go from $1 million property with a $500,000 mortgage to a $500,000 property with a $100,000 mortgage. Has to be of greater or equal value. Number 4, you must not receive boot. You know, being from the South, I've always heard the old timers talk about boot. I'll give you $10 to boot. What? Believe it or not, that's actually a term in the IRS code that they use. So a taxpayer must not receive boot in order for the exchange to be completely free. In other words, you can carry out a partial 1031 exchange in which the new property is of lesser value, but this will not be 100% tax-free. If there is boot, if you are paying someone boot for the property, you could be taxed on that. So an example of this would be, let's say your property sold for $500,000 and the property you wish to buy is worth $4 million. You would need to pay the normal capital gains on the difference between what you sold and what you buy. If it is of lesser value, that is called the boot. Mainly because the boot can kick you in the backside. So, all right, rule number 6, there is a 45-day identification window. This property owner has 45 calendar days post-closing of the first property to identify up to 3 potential properties of like kind. All right. It can be difficult sometimes if you can't find properties within that 45 days. I see that happen here a lot because properties go so quickly on and off market. By the time you've got them identified, they may be sold. So you've got 45 days from the time you close the first property to identify and secure the additional properties. All right, that's something important to keep in mind too. You might want to start shopping before you sell off the first one. The final rule, rule number 7, there is a 180-day purchase window. It's necessary that the replacement property be received and the exchange completed no later than 180 days from the sale of the exchanged property or the due date of the income tax for the tax year, which is normally April 15th. Basically what that means is, as rule number 6 said, you've got 45 days to identify properties. You've got 180 days to actually complete the transaction. So again, 1031 exchanges are very complicated. You quite often need to get a third party involved depending on the type of exchange that you're going to do. Someone has to hold that money and deal with all that ramifications there. So again, not an accountant, not a tax attorney, not giving you tax, legal, or accounting advice. I'm just telling you what I found on the old internets pertaining to 1031 exchanges. Hey, I want to remind you of a couple of folks that we do a lot of business with, sponsors of this program. First is Stephen Allen with Caliber Home Loans. Stephen and his team, they are the best at getting things done for you. They can find you the best rate, the best terms, get you closed out quickly. If you mention to Stephen that you heard about him here on the video, he is going to do your home appraisal absolutely free. We also do a lot of business with Jacob Title. Stan McDonald and his team at Jacob Title, they are the hometown closers, and Stan can get everything done quickly, professionally, legally. And if you mention to Stan that you heard about him here on the video, Stan is going to knock $100 off your closing costs. And as always, if I can do anything for you when it comes to real estate, don't hesitate to call 256-679-0704. You can find me on the web at revolved.com or on Facebook. If I can help you sort through a 1031 exchange, I do it all the time. A good portion of my clients now are investors, and investors are rolling over that money quite a bit. So I'm involved in a lot of these kind of transactions, so we can sit down, go a little deeper and talk about it and see what we can do to help. All right. So there you go. If you are an investor and you are selling property and you are making a profit that you would like to shield from the IRS, this is a great way to do it. All right, guys, if I can help in any way, don't hesitate to call. Otherwise, have a great day. Talk to you soon. Bye.